Now we have Warren Buffett's final rule for investing in any stock, rule number 4. Rule number 4 is purchased at an attractive price, where Mr. Market gives me a deal. Before starting the video, I just want to outright say that this isn't a video that's supposed to be implying that Warren Buffett has a secret formula to finding the intrinsic value of a stock. That's ridiculous for a number of reasons. If you do see someone pretending like they have all the answers and that they'll sell you answers, you should think twice about taking them seriously. If they could get 50% returns yearly with a strategy, why would they tell you? In this video, I'll go over quotes from what Warren Buffett has said in his letters and interviews about intrinsic value, and try to interpret them in my own words. We'll start things off with quote number 1, which is about discounted future cash flow, where he says, "The value of any stock, bond, or business today is determined by the cash inflows and outflows, discounted at an appropriate interest rate that can be expected to occur during the remaining life of the asset." Going into the discounted future cash flow model will take a lot of time, so I'll give a very general idea of what he means here. I might make a video addressing DCF models in the future though. Obviously, if we were buying a business, we'd want to have more money coming in than would be going out. Perhaps they are losing money now, but will become very profitable in the future. That's why currently unprofitable companies still have investors. They believe the future returns will outweigh their current poor position. But let's go back to what even is discounted cash flow. Here's a bar chart to show generally what's going on. Even though the actual cash grows over time, since it's a good business, we can see that our discounted cash flow value per year decreases over time. The amount that gets decreased is based on our discount rate. So for a more accurate discounted cash flow model, we need an accurate number on the actual business growth, plus we need an accurate and appropriate discount rate to be going along with it. Let's start with growth. This one is one of the hardest to determine. If we knew for sure how big a company would be 10 years from now, then investing would be a lot easier. Since a company could fall or not match expectation, this causes risk. And this is why Rule 1 in our previous video talks about sticking to a business that you know well and can predict into the future more easily. I'd recommend seeing that or rewatching for predicting future cash flow. As for our cash discounted each year, that depends on what we want as an annual return based on risk. The bigger the risk, the higher the discount taken off each year. Taking off more of a discounted rate means the estimated intrinsic value for today will be much lower. After determining growth estimates and your discounted rate, then you have to make an estimate on value. And that comes to quote number 2. As our definition suggests, intrinsic value is an estimate rather than a precise figure, and it is additionally an estimate that must be changed if interest rates move or forecasts of future cash flows are revised. Two people looking at the same set of facts will almost inevitably come up with at least slightly different intrinsic value figures. And there you have it. Even Warren Buffett says that these calculations are estimates. So since it's an estimate, you're likely better off making conservative estimates with lower growth rate expectations and a higher discount rate to help protect your principal if you're wrong. And that brings us to quote number 3, purchase with a margin of safety. We insist on a margin of safety in our purchase price. If we calculate the value of a common stock to be only slightly higher than its price, we're not interested in buying. We believe this margin of safety principle, so strongly emphasized by Ben Graham, is to be the cornerstone of investment success. I made a previous video going into what exactly margin of safety means and how to apply it. If you're interested in learning more, I highly recommend checking that video out on my channel. And that brings us to the end of Warren Buffett's 4th rule for purchasing any stock, to be purchased at an attractive price.
If you're new here, subscribe and hit the bell for notifications to see updates on this series and other series that I'll be doing in the future. And if you enjoyed the video, hit the like button so that others can see it as well. Thank you so much for watching, and I hope to see you in the next episode.